Hello everyone, welcome to PMS Insights. It is a well-known fact that equity markets are driven by sentiment in the short run. In the words of Benjamin Graham, markets are voting machine in the short term and weighing machine in the long term. The short-run factors in the public opinion, which may also be loosely termed as momentum investing, whereas what matters in the long term is actual underlying business performance driven by fundamentals of a company. Currently in India, companies with high promoter pledge, high debt, and corporate governance concerns are being exited by investors, and we are witnessing a flight of capital to safer companies. Most of the MNCs also fall in this bracket. MNCs have more independent management, global economies of scale, higher standards of product quality, brand equity, and strong distribution capabilities. In times of economic stress, they are relatively better placed than others. Their parentage also gives them access to technology expertise, strategy, and execution capability. MNCs generally have a higher return on invested capital, cash flows, and asset turnover with lower leverage. While they tend to trade at higher valuations, they also reward the shareholders, higher dividend yield being one of it. While all MNCs cannot be painted with the same brush, select companies in the MNC space appear attractive, and we have some of the names like Bata, Nestle, Siemens, Cummins, Sanofi across our various offerings. Around 20% of our portfolio companies comprise of these MNCs. Nestle, with its cluster-based approach of driving sales, continual innovation by launching new products, is the market leader in most of its product categories. It's a cash-rich company with ROE in excess of 50%. Bata too has a debt-free balance sheet and is focused on expanding in Tier 2 and 3 cities with its product offerings across women, youth, and sports categories. It has maintained its leadership position in a largely fragmented Indian footwear market where there's a lot more scope to improve market share. The last couple of months have been painful for Indian equity investors, mainly due to macroeconomic, geopolitical, and global uncertainty with respect to US China, US Iran, and Brexit issues. While the companies with weak or deteriorating fundamentals are more affected, even those with strong fundamentals are being temporarily influenced with minimal or no impact on their long-term earnings trajectory. On the contrary, this scenario presents an opportunity to buy fundamentally well-placed companies at a better price. While we are constantly re-evaluating our portfolio, we look for evidence where our investment thesis might change, and if such is the case, we do exit the name. However, if fundamentals remain unharmed and prices continue to drop, we continue to hold and maybe even add to the position. From a valuation perspective, the Nifty 500 and Nifty Midcap Index have corrected by 6% and 15% respectively in the last 1 year. While there might be some pain in the near term, from a 3-year perspective, there are ample growth opportunities for the Indian equity investor as the structural growth story for India remains intact. Thank you.